Hello and welcome to this first virtual televised panel debate with IPSX, which asks the question, how might financing real estate change post-COVID-19? My name's Paul Norman. I'm the editor of CoStar News, which is part of the leading information provider, CoStar, on commercial property and other things. It's my pleasure to be your host today. In our virtual studio, we have a panel of experts who are ready to try and answer this and other questions on real estate financing and the options developers, asset owners and landlords are now facing. It's my pleasure to introduce Roger Clark, Managing Director and Head of Capital Markets from IPSX, Amiga Paul, Head of Debt Advisory Services from Michigan de Rea, Richard Croft, the Chairman of M7, and finally Dominic Cunliffe, who's Partner Real Estate at McFarlane's. Almost every real estate business across every sector in the UK has clearly been badly affected by coronavirus. In this debate, we're going to be discussing the options that real estate asset owners, developers and public companies now face when thinking about capital raising and the options they have for raising new finance to reinvest in their businesses or for further new development. So let's get started with Roger Clark and get up to speed with what's been happening with IPSX and why he thinks IPSX could offer a new solution to asset owners. So, Roger, what progress has IPSX been making over the last 6 months or so?
Hello, Paul. Well, we now have two markets launched and live. Our first market, IPSX Prime, is designed for stabilised income-producing assets. These are low risk, low leverage. They're open to all investors, including retail investors who are looking for stocks to go into their ISAs and SIPs. Our second market, which is new for 2020, is called IPSX Wholesale. And this is only open to institutional and professional investors. And here we're going to see assets with higher leverage, potentially higher risk and higher returns. In terms of progress we're making, the prospectus, which is the document which is needed to be filed and produced, it's a very high standard of document produced by lawyers, accountants, valuation agents. The prospectus on our first prime IPO is with the FCA. It gets pre-vetted by them in advance. It is with them. We have another 3 or 4 deals which are similar to go onto IPSX Prime, and these will follow quite quickly. And I hope we'll see, therefore, by the end of the year, a handful of IPOs on Prime. Wholesale,
great,
a newer market, is likely to see its first admission on a similar timeframe.
Okay. How does and how can IPSX help with fundraising for asset owners? Obviously, it's a new thing. It's been talked of before, but this is going to happen, and it's new. So how can it help?
Well, IPSX is going to open up real estate to significant new pools of capital that today aren't active investors in the asset class, or at least not in securitized listed real estate assets. It's important, of course, to note that what we're doing at IPSX is securitizing buildings. So these investors, they include retail brokers, family offices, wealth managers, IFAs, private banks and their clients, as well as at the other end of the spectrum, some of the biggest institutional investors like structured solutions managers, fixed income investors, convertible bond investors, defined contribution pension funds. All of these are investors who don't typically invest in listed real estate. Literally trillions of pounds of capital is seeking asset-backed sources of income with daily pricing, liquidity, and a regulated venue. So IPSX makes it possible for asset owners to access these huge new pools of capital.
Okay, well, thank you, Roger. That's very interesting to hear. There's clearly a lot of advantages to what you are bringing to market there. I want to bring in Richard Croft now. Richard, how are you seeing the market today?
Paul, great pleasure to be here with you, first of all. And second thing, it's such a really wide question because there's lots of different answers to that. So
yeah,
real estate generally, I think is going to come out of this quite well as an asset class. I know that sounds peculiar after such a dreadful pandemic, but as we've seen with the performance of the stock markets over the last 6 weeks, which have been, unbelievable. But what it does show is just the strength of liquidity, how much capital there is to invest. If you now compare it to fixed income, the reality is that anything that actually produces an income is going to be very valuable. I want people to understand that in the waterfall of payments, real estate actually is senior to equity. And what I mean by that is, if you've got a company that you've invested into the shares, and you've invested in the shares because you're expecting a dividend, well, you're better off investing directly into the real estate in which they occupy, because they have to pay their rent before they pay you a dividend. Now, that might be quite a neat segue into IPSX, which I think is one of the things we're here to talk about.
Yeah, absolutely.
A new stock market, the new recognized investment exchange from the FCA. So the FCA has approved IPSX as a stock exchange, a recognized investment exchange, and it's going to give people the opportunity to invest directly in real estate for the first time. So effectively tokenized ownership of real estate. And so you now don't have to invest in a REIT on the London Stock Exchange with the management that it comes at quite an expense or a discount. You can invest directly into a single building. And I think for a lot of investors, that's going to prove to be very attractive. And also it means that they can get in at the top end of the waterfall, because all that happens is the rent is paid and the dividend is paid from that company that owns that asset, but it's going to be fixed cost management. So you're getting the direct benefit of real estate distributions. And I think that looks very interesting.
Do you expect any price adjustments in particular as well before we move on?
So here's the thing, right?
Yeah.
If you believe that income is going to be the great generator.
Yeah.
So, 6 weeks ago, I was busy plotting a massive recovery fund. I'm not sure there's a lot to recover. Stock markets have sort of told you a story about the weight of money, the investment money. So, obviously there is going to be a difficult market for shopping centres moving forward. As I said, I think that's a sector that's been on arrival now. And obviously there's going to be a very difficult market in leisure and hospitality for a year or two. But in the regional office sector and urban logistics and retail warehousing sectors that we're in, I mean, why would you sell at a discount? The occupier markets have remained relatively strong, all things considered, and I'm sure there will be, there is definitely some economic hardship. I think the stock markets are ignoring the economic hardship that there is, but if you're chasing income, there's not going to be any new development during this period. So, supply is a cat. Interest rates are very, very, very low. So if you can buy anything above 6-7% yield and keep it let, that looks very, very, very attractive. So, will there be opportunities? Yes, there will be some. But I don't think that the valuation market in the sectors that we invest in is going to massively collapse. I mean, I'm pleased because obviously we earn a lot.
Yes.
So I might be talking my own book, but we've certainly not seen any evidence. We've sold probably 70 million euros of kit of assets during the pandemic. Maybe a bit more, actually, maybe 100 million. And we haven't granted a discount to anybody.
Okay, let's bring in Amelia Paul, Head of Debt Advisory Services at Mishcon de Reya, obviously an expert on lending at the moment in the market. Amelia, how are you seeing the market just now in terms of transactions activity, and also are banks changing their position in response to the pandemic?
So I think it's fair to say, Paul, that transaction volumes are much lower than they would have been pre-COVID. It's a good thing that the lending market as a whole in the UK was in a much better place pre-COVID than, say, for example, before the global financial crisis. So across the board, leverage was much lower as a whole, and also security was generally much better. But we're certainly seeing banks retrenching with a particular focus on managing their existing loan books and supporting existing customers. And also a large amount of bank time is being spent on the government-backed schemes, so the CBILS and the CILBIL schemes, for example. So we know, anecdotally, we've been told that some origination teams are spending so much time on these, underwriting these schemes, and the rules are constantly changing, that they really don't have that much bandwidth outside of that to look at new origination.
Okay, I mean, in terms of new origination, are they changing that as we move towards some evidence of lockdown, retail beginning to open next week? Do you think banks are still willing to lend against property at the moment, or is it very, very rare, or is it very specific asset classes?
I think banks are still willing to lend. There's certainly a flight to quality and a particular focus on existing bank clients. So just to give you one anecdotal example, we're working at the moment on financing an operational asset for a client which is already banked by one of the clearing banks. And we know that despite that bank already banking that asset, they would not be willing to look at financing our client because they're a new to bank customer. So we can see that banks are really focused on supporting their existing clients and managing their loan books. And in fact, as we see an increase in stress and de-stress, which I think everyone is expecting in Q3 and Q4 this year, we'll see even more pressure on banks as there are increasingly covenant breaches and defaults and NPLs.
I guess one question there is you obviously there's a comparison that's being made with 2008. I mean, do you see a different attitude from banks at the moment towards distress? Is that going to happen when that begins to happen in the third quarter than happened back at the GFC, basically?
There's certainly been a lot of government support for banks to continue supporting their supporting their borrower clients, and we've seen a lot of discussion in the market about banks continuing to support existing customers. I think as after the GFC, banks will begin to focus again much more on quality. We'd certainly see an increase in NPLs. Just in the retail space, for example, the CAS UK CRE lending report suggests that we might see 10 billion of write-offs in retail, just to give a sense of the numbers that we're talking about. And we also know actually there's a huge swathe of loans that will need to be refinanced in 2020 and 2021. So 43 billion of loans coming up for refinancing. I suppose the distinction from the GFC is this time round we do have a much larger proportion of alternative lenders in the space. Many of those obviously came in to finance the so-called funding gap after the GFC. Some of those lenders have moved out of the market in the light of COVID. So we've seen their own funding lines being withdrawn and they've retrenched, but others are actually finding that their business is triple-fold what it would have been pre-COVID. And they're actually looking at underwriting a lot of the transactions which clearing banks, for example, would previously have underwritten, or indeed others, other alternative debt funds that are now have moved out of the market. So the market is much more diverse than it was just following the global financial crisis.
Thank you, Amelia. Richard, perhaps you'd like to come in on this question about banks still lending against property. And what are you seeing in terms of margins and terms? And if they're not, what needs to happen to unlock activity?
Yeah, they are lending. When you ask them all, they'll tell you they're lending. I think not huge amounts. They're waiting for the credit markets to turn down, but or turn up. The balance of probabilities is that. I've got to be careful here, but it looks like the virus is weakening in Europe, certainly in Europe, not the Americas yet. Most of Europe will open up, we think, now by September. We thought probably the middle of next year at one point, but it looks, that we'll be back to some semblance of normality by September. At which point the banks will be back because they've got to lend money. That's their business. I think there'll be a small uptick in margins, but if it is assumed that all the quantitative easing that has pushed money in to the credit markets and all the fiscal stimulus that is coming broadly protects asset values, if not the economy. I think the economy is going to have a tricky period for a year or two. But the reality is that the banks will be there, I think. It seems unlikely to me that the banks aren't going to be there because they don't have a business if they're not. So there's not been a lot of lending in the last 12 weeks. There's not been a lot of anything in the last 12 weeks. But there's mass liquidity in the system, which, people forget about the GFC, that it was actually the GLC's great liquidity crisis.
Yeah.
I think the economic crisis for the next year is going to be tougher than the GFC. But it is, I think we're seeing a 10% reduction in GDP across Europe. It will take 2 years to get back to where we were. But there is no shortage of liquidity. And that's good for real assets. So the asset economy is going to outperform the real economy. And I don't think that's a positive thing generally. I mean, I speak of somebody who manages assets, but the reality is that long term, one of the things the government needs to address is that capital is being rewarded substantially ahead of labour. I could do hours on this. I'm not going to. That I'm not a great fan of our government or a great fan of the political direction of the country, but we've got the political direction that we have, and we've got the government we have, and one of the things they need to start addressing is how labour gets better. Because across the globe, what massive fiscal stimulus and massive quantitative easing does is value capital above labour. And that's a long-term problem that nothing to do with real estate, but that's a long-term problem that I would like to see governments start to address over the course of the next 5-10 years. Because if we don't, the unrest that we've been witnessing over the last few days, which is not just about race, it's also about inequality, and it's about the direction of travel of a lot of the world. If we don't start addressing those issues, then those positions are only going to get worse, and that's not a good thing.
Thank you, Richard. You raise a lot of very important points there. Before we bring in Dominic for the first time in this debate, I just want to quickly go back to Amiga. Amiga, in your opinion, what new strategies need to be considered by executive teams to help raise cash?
So I think there are a wide array of different capital raising strategies that borrowers can look at. Obviously, traditional financing. In fact, we're speaking to lots of clients about transitional financing, where they're looking effectively to weather the next 12 to 24 months, particularly clients that have operating businesses underlying the real estate. There's ability to look at your portfolio and work out if you should make strategic disposals. There are various long lease strategies which borrowers can consider. So whether that's sale and lease back, income strip transactions, or ground rent type transactions. There's also obviously the ability to look at the equity side of life and with potentially private placements. But the challenge of private placements is to find the right fit. And obviously there's an element of giving up control, which potentially an asset manager and owner wouldn't want to do. And then for the more established and bigger players, there's potentially access to the capital markets on the debt side and the equity side. And we're increasingly seeing some innovative strategies where there's the ability to list for trading single assets or portfolios of assets, which may provide an alternative to raise some equity, release some capital, whilst the underlying business managers and owners can retain control, and indeed can also gear with traditional debt financing those underlying assets.
So I hear, I guess you're pointing in part to IPSX and what's coming.
That's right.
Coming down the tracks there. And obviously that's something you would see as a very valid way of raising capital.
Exactly. It's one of a number of different strategies which real estate owners and operators should be looking to consider.
Okay, finally, let me go to Dominic Cunliffe, partner real estate at Lawyers McFarlane's, who's really been involved in piecing together a lot of significant deals over the years. So it'd be good to catch up with Dominic on corporates and how they're financing real estate and how they're doing that during the pandemic. Dominic, first of all, what options do real estate owners have in terms of financing real estate deals at the moment? Clearly, there's not that many happening, but I bet you're doing a lot of work helping them find ways to do it.
Thanks, Paul. Well, I mean, clearly, real estate businesses are under pressure as a result of COVID. Cash flow is key, and maintaining that. I mean, we're seeing rights issues. Whitbread have very recently successfully had an issue to effectively secure additional income for the Premier Inn business that they own. We've got the bank debt, of course, is still available. It'll be interesting to see how that adapts to the drafting that we're starting to see in leases with rent suspensions, which create a hole in the income stream, and how that's going to tie in with the ability to cover the interest payments. Obviously, any corporate can sell an interest in its business shares, and you can, of course, and we're starting to see this, look at selling property you don't need as a core part of your business. So sale and leasebacks. I mean, the food retailers have been doing this for many years, and we've acted the supermarket income REIT, and they've been very busy hoovering up.
Yeah, they've found themselves in the absolute best place, haven't they, at the moment, it seems.
And then, of course, you've got the corporates who are trying to preserve their cash flow rather than get additional cash flow. So we've got the CVAs being threatened by the likes of Travelodge again.
And what options do real estate owners have to structure ownership at the moment?
Well, I mean, structuring real estate ownership, I don't think has changed as a result of COVID-19. You can directly own it. You can own it through any number of structures, from a UK company, an overseas company. That could be a REIT, onshore, offshore. And you've also got JPUTs and other vehicles like partnerships, which it really depends on the nature of the investor, their tax position. Some vehicles are more tax transparent and efficient, and it will be interesting to see how that continues to change. I mean, certainly there's a real reputational pressure, and there's a pressure in terms of reducing tax benefits, but to bring businesses onshore as opposed to keep them offshore.
Back to Roger now, please. And obviously with this sort of COVID-19 hat on, if anyone wants to wear one of them, I'm not sure. But thinking of that, what sort of assets are people looking to invest in today? And is that being changed by the pandemic?
I think it has a little bit. I think what we often hear people say about the COVID-19 lockdown is it is accelerating trends which we already saw. And I think that's certainly true in terms of what is the more attractive types of real estate. What are they? Well, more than ever, it's robust, secure, long, strong sources of income. And look, only yesterday, Jerome Powell, the chairman of the Fed, said that he's not even thinking about raising interest rates. So long leases, strong quality tenants are effectively replacing corporate bonds as a source of income. And if we look in the listed markets at who's been raising money during lockdown, it's medical property, it's food retailers, it's logistics. These are all real estate where the tenants are going to prosper in the new normal post COVID-19. And with SEGRO's fundraise just this week, we now have seen over £1 billion worth of capital, new capital, equity capital raised in the UK, all of it at a premium to NAV.
Leading on from that, Roger, there is a burning question though, and perhaps Dominic, you could help me with this. Who wants to buy real estate if tenants aren't paying rent?
Well, that's a very fair point, Paul. In reality, I'd start by saying real estate is not dead as an investment. I mean, real estate outperforms virtually every other asset class over any medium to long-term period. It's also fundamental to the UK economy. I'd say it's not for the uninitiated. We're looking at sophisticated investors who are able to price risk, particularly given the heightened uncertainty and the additional risk that exists at the moment. They need to be able to understand the underlying occupier's business, its strength and its ability to adapt to this climate we're finding ourselves in. It certainly isn't for someone who doesn't have that sort of ability to analyse and a real estate background, and they've got to be careful because we're seeing things like prepacks and CVAs being used. Anybody looking to invest in real estate or finance real estate will have a concern around that.
Amiga, do you have anything to add into this question about rents?
So real estate has always been, I think will continue to be a long-term investment. And we're all hoping, obviously, that the impact on income is going to be relatively short to medium term. As you were mentioning, in terms of lease structures, it's likely we'll move much more, particularly for retail, to a month by month rather than a quarter by quarter basis. And also likely that we'll look more at turnover leases where there'll be some share of upside and risk between landlord and tenant going forward. We've had a lot of discussions with overseas clients of ours who are very keen to invest in real estate in the UK market, but are struggling to find a product to invest in. And when they do, there seems to be currently a mismatch in pricing expectation between vendors and buyers. And as the market is generally expecting there might be a price correction across the board, you can see why vendors who are not yet in a sort of required to sell their assets may prefer to wait and find out where pricing and values end up rather than looking to take a bigger discount now if they were to do a deal.
I guess another question is, how do you think the outlook for real estate markets are looking as we now begin to think about the easing of lockdown or what post COVID-19? What's the outlook for them?
So I think general market sentiment for capital in real estate markets is pretty pessimistic in the short term.
Yeah.
I don't know if you'll have seen the results from the Croft second quarter survey, but 75% of participants think that things will be significantly worse from a capital perspective.
When did that come out? That sounds really interesting. Yeah. Sorry, I should.
So just that was the end of Q2, so very, very recently.
Yeah, I'll pick that up. Yeah.
So 75% are very pessimistic and 25% are moderately pessimistic, which I think shows where sentiment is as a whole. But that's not homogenous across the piece. So with offices, the number's sort of around 60% pessimism, whereas with retail and hospitality, it's much closer to 100%. So it's not going to be the same across the board for all asset classes, as we're discussing. So offices and logistics may well fare better than retail and hospitality in the short term.
Roger, let's bring you in. Who wants to buy real estate at the moment?
Yeah, I mean, that's an interesting question. And I think, Mark, as you said earlier on, Paul, have markets been irrational? One of the things we're beginning to learn is that a lot of professional institutional investors are very long of cash and have effectively sat out the recent rally. And I think some of them are beginning to now sort of hold their hands up and say they regret that. What we see with the more multi-asset focused investors, and indeed people effectively investing their own money, whether that's retail investors, whether it's family offices, clients of private banks, etc., they have continued buying assets since April. They have continued to look at asset markets as buying opportunities. But of course, as I mentioned earlier on, they are primarily looking for income, and they're struggling to get it from the places where they traditionally look for it. So they're being drawn towards real estate. So it's really exciting that we are seeing new players come into the real estate capital markets, which is good for all of us.
Continuing on this subject, Dominic, what assets do you think people are investing in today? And you've touched on this, obviously, but it's good to drill into that.
By sector, for starters, but clearly it's also, one of the key considerations is the underlying occupier, and of course, to what extent you can ensure that you have an equivalent occupier going forward. I don't think there's any one particular form of investment that an investor will automatically want in its portfolio. But clearly, I think we're going to see increased demand for the logistics distribution business. We're going to see, I think, further build to rent. I don't think office demand is necessarily going to fall as much as everybody expects. I think working from home is likely to become more prevalent, but in combination with working in the office. So the office facilities still need to exist. That won't be the same for every business, but across the piece, I think it will be. We're also going to see opportunistic investors, what they now call the rescue funds, what we used to once call the vulture funds.
The vulture funds, yes.
If you think about hospitality, you've got some ground lease structures there. Those could be under quite a lot of pressure, and I'm sure that I know that people are looking closely at those. And then you've got the investments of tomorrow. I mean, regeneration, rebalancing, that was very much this government's motto. They were really open to any ideas. They've been sidetracked by COVID-19, but if you assume that the debt that they've taken on can only be treated as a war debt and pay back over a very long period of time, one would hope that it frees up the possibility for them to really push hard on regeneration.
Very interesting points. Thank you, Dominic. So, Roger, same question to you. Obviously, you've got to decide which assets are going to be on IPSX. What are people investing in? For example, are shopping centres out of the question?
Well, I think it's interesting. The answer is it's very asset specific. I mean, to take your example of a shopping centre, there are certain shopping centres here in the UK which will, when they reopen, continue to perform very well. I think the issue for investors is that if you're offered the chance to buy shares in Intu or Hammerson, you get the good with the bad. And you don't really have a choice as to which specific assets you can be exposed to. And again, it's part of the vision we have behind listing single assets on our exchange, is that you can actually specifically choose. And that allows you to then have the transparency, which we think is a very important part of the modern investment markets, that you can begin to look at the performance of the individual asset and decide whether you want to buy that or not. So if you have that transparency, certain assets will perform better than others across all sectors. So anything could be appropriate for IPSX. It depends on the asset.
I mean, the stock markets have been volatile, obviously, and to some degree irrational. It seems in some of their responses. What does that say? Does that prove that real estate should not be listed, or should? Well, I know what you're going to say here, but just ask you about that. How do people look at that and respond to that?
Paul, you're right. I am not going to say that real estate shouldn't be listed. Daily pricing.
The sudden Damascene moment where you think, "Oh no, this isn't quite right."
I mean, daily pricing of listed real estate that provides up to the minute transparency on valuation. That's a good thing. And as I mentioned earlier on, it's going to allow people types of capital into the asset class that need daily pricing. It also, of course, and sorry to point out the obvious, it stops gating or the closing down that we've seen in open-ended funds. I think though the point, and to your point, it is a good one. Being listed on a stock exchange like the NYSE or the London Stock Exchange, Euronext, along with technology stocks, banks, telecoms, drugs companies, and in the UK here, listed real estate being less than 2% of that market. What it means is that REIT share prices get pulled around by macro traders, program traders, hedge funds. I mean, take land securities. It has an almost perfect correlation, a beta of nearly 1 to the FTSE 100 index, and you do not buy REITs to get FTSE 100 index tracking. So I think the question isn't whether real estate should be listed. The important question is, where is the right venue for it to be listed?
Yeah. Continuing on this subject, Dominic, if you don't mind, the same question to you. Is it a good idea listing property?
I think the problem with listing on the main market is it's difficult to differentiate your business from the general market noise and market sentiment. All shares tend to fall. It's not you don't have that sort of transparency as to the underlying assets of a real estate business. You look at a British Land or a Land Securities; they hold huge portfolios, and very few investors really understand what the detail of those holdings are. So, potential listing of aspects of businesses that are on the main market on IPSX would clearly be, it would allow them to have a more transparent valuation, a better understanding of the asset they hold, what their intentions are for it. Perhaps could be used in conjunction with the main market listing for certain assets. We also, I think, when we talked about sale and leasebacks, I mean, there are accounting issues obviously that need to be overcome and regulatory issues. But if we put those to one side, one of the issues with sale and leasebacks, opco structures is a business selling the crown jewels once and for all in order to obtain capital for the operational business, with the potential to sale and leaseback using IPSX. You could see a business being able to retain control and possibly buy back the property interest and property vehicle at some point in the future.
Yeah, absolutely.
Those are things that we speak to clients about, particularly interesting. You've also on the sort of subject, I think, of whether what IPSX could offer the industry. It's the approach that they're adopting is one of flexibility. So they're open to discussions on any possible listing and what that might involve within certain parameters. But it has the benefit potentially of allowing offshore REITs to come onshore. And again, there's a reputational issue there. I think people are very keen to avoid any stigma associated with an offshore operation. There's less regulatory, less on the regulatory and tax side to make that beneficial, and so it'll be interesting to see if that is a space where IPSX can fill a gap, create a new market.
Richard, what would you add to this part of the discussion?
The stock markets are driven, as we saw, by the massive leg down, the massive snapback, by a whole lot of algorithms now and a lot of electronic trading, mass electronic trading. And one of the arguments for real estate having its own stock exchange is that actually then it will be less volatile. Because if you look at how the major indices perform, you just had massive funds selling massive positions, then margin calls, more sells. Now you've had the snapback because of the excess liquidity created by QE and fiscal stimulus. I mean, you've got a very unhealthy market. So we've seen a 40% leg down and back in 12 weeks in our blue chip indices. That doesn't make any sense, And so what you're saying is, when you've seen American Airlines jump 50% in the last couple of days, what has made American Airlines worth 50% more than it was on Thursday?
Yeah.
The answer is absolutely nothing. I mean, I look at that business and go, I want to invest in that. But it is, that's what the mass liquidity does, and that's why you have volatility in the stock market. And what we're saying is that real estate, actually, people do want to have liquid access to real estate capital markets. They do want to be able to day trade positions. They do want to be able to own real estate directly, as I said, without having to do it through other people. So, an IPSX allows that. And I think that real estate really does need its own exchange and really does need, the benefit of a tokenized capital market.
Over the years, other people have tried to do this.
Nothing like this. And so, a very good friend of mine, who will remain nameless, actually I'm tempted to name him, but if he watches this, he might be upset. Said to him when I got him involved, he said, "Oh, we did this years ago." No, you didn't. Years ago. This has been approved by the FCA as a recognised investment exchange, but one of only 7 in the UK. The London Stock Exchange. This is massive. This isn't a crowdfunding platform, which I think are a different entity entirely. This is a stock market. It's going to be a market-made stock market. You've got to trade shares on your phone. When we've got this all up and running, we've got a large number of market makers coming into the market. There is liquidity, genuine liquidity. This is a stock market, a recognized investment exchange. When people say, "Well, we've been here before," no, we haven't. No, we haven't. This is new. This is hugely exciting, and it opens up a fantastic capital market for the real estate industry. This could not be more exciting. And actually, what COVID has shown is the need for the exchange is greater than ever. And I'm hugely proud to be part of it, or a small part of it as a non-executive director. Hugely honoured to be an investor. And I think when people understand just how exciting this is going to be, I think we're in for a massive success here.
Well, that's it. Thank you to my guests, Roger Clark, Richard Croft, Amelia Paul, and Dominic Cunliffe. There's no doubt that as we emerge from COVID-19, we need to get the economy moving again. And having more options to finance real estate assets and projects is obviously going to be crucial. My name's Paul Norman. It's been a pleasure to host today's program. Thanks for watching, and I hope you found it interesting. Goodbye.